What do you guys think? You want to kick it off, Barry and Joe? Yep. All right. Let's do this. All right. Welcome, everyone. We're really excited to be here. We're here talking about the Paycheck Protection Program and the Employee Retention Tax Credit. Speakers today, my name is Chris Zingali. I'm a principal at Janover. I run our firm's consulting department and our digital advisory solutions group. I'm here with Barry Sunshine and Joe Tanzer, two of our senior tax partners, and we make up Janover's COVID resource team. We've been really the leading force behind our firm's PPP work, employee retention work, and pretty much everything associated with all of the new programs that have been, kind of rolling out over the past year or so. So thank you for being here. On the agenda today, we have a really good agenda. There's a lot of stuff. We try to kind of focus all the questions we get from clients, and we try to package it up here and make sure we cover a lot of those points in the webinar, because we do get a lot of the same questions. So we are really excited. We're going to be talking today primarily about the Paycheck Protection Program. We're going to go through some clarification and new guidance related to first draw loans. Those first draw loans would be whether you got a loan, a couple months back during that first round of PPP, you got your first draw, or some businesses who are just getting their first draw now during this new process as of December. Next, we're going to go through some key provisions related to the second draw, because there's a lot that you need to know about that second draw. We're going to go through some tax implications and some financial reporting for forgiveness around PPP loans. We're going to get into the employee retention tax credit eligibility. This right now is probably the biggest topic, probably even bigger than PPP right now in terms of us as a firm, how we're servicing clients right now. And we're going to get into all the details why it's so important and why it's more important now than it was, say 6 months ago. Then we kind of have some bonus content in here. There is a new SBA program called the Shuttered Venues Operators Grant. We figured we may have people on the webinar who may qualify for that. So towards the end, we're going to just cover really one slide really quick on that, just to kind of give you a high level summary there. As we jump into our session here, we try to do polling questions in order to get a kind of good idea of our audience, because we can kind of tailor some of what we're speaking about. So one of the key pieces is just the size of your first PPP draw. What was your first draw? Was it 150 or under, 150 to 2, over 2? Maybe you didn't take a first draw, or you're just here so you could learn a little bit more. So I'll give everyone a minute or so. And as you probably know, for those of you who did get over 2 million, there is the forgiveness process around the size of the loan does slightly vary. We're going to be going through that in a lot of detail, but we figure we kind of post this question and we kind of get an idea of who's out there. So let's end the poll. Let's see. All right. So the largest part of our audience, 82%, is between 150 and 2 million. That's good to know. And then we have about 10% split between 150 or under, and 10% split over 2 million. That's good to know. So as we get into this, everyone probably knows the CARES Act was that original act that was signed back in March of 2020, which gave us that first PPP draw. In December 27th of 2020, the end of the year, that $2.3 trillion stimulus bill was signed into law. And within that, there was about $900 billion of COVID stimulus relief. That COVID stimulus relief primarily included a pretty significant or major expansion to the employee retention tax credit, which again is really an important topic right now. More available PPP funding, which everyone is probably aware of. It gave us that second draw, and it kind of refunded the PPP pool of funds. It gave an extension to certain deferred payroll taxes, and finally certain unemployment benefit extensions, primarily that $300 additional unemployment benefit. Just to put into perspective here, what we're talking about when we're speaking of the PPP now, under the CARES Act allocated about $660 billion of funds into the PPP pool of money. Only about speak, small numbers here, only about 520 billion of that was funded. So 130 billion of that went unused. And of that 520-ish, about 5 million loans were funded. So 5 million businesses were helped out with PPP funds. Moving forward to CAA, right now there's about $285 billion of PPP funds. And while it is smaller than the CARES Act round, it is also more restrictive in terms of eligibility and who qualifies and the size of the loan. So given it's a smaller pool of businesses that are eligible, so it really is impactful. Let's just jump right into it. I think Joe's going to start us off. We're going to start with changes to first draw PPP loans. Want to take it over, Joe?
Yes, thank you. That was a great introduction, Chris. Good morning, everyone. And you're here to go over this PPP again. Probably you've heard a lot about it in different webinars. We hope to give you a slightly different perspective in this one. So let's get going, and let's, as Chris mentioned, we're going to first talk about the first draw PPP loans. And just to make that distinction, these are the loans that you're either getting for the first time now, or even the ones that you had back in the early days of this program back in 2020. The second draw, which we'll talk about later in the program, will deal with those people who've gotten a first draw and now looking to get some new money. So based upon the pop-up that we had before, it looks like everybody's gotten the first draw. So this is just about modifying. We'll look at it from that perspective here. One good thing to note as we talk about this, one of the changes that came out of this December 27th law is that now you can actually use this program and use the ERTC as well, the Employee Retention Tax Credit. And that's important as we go through this stuff. What I'm about to discuss on this page is very important, because now we can start to move things around. If you haven't already filed for your forgiveness on the first draw, this is an opportunity for you to move some things around. And let's go into it and you'll see exactly what I mean. Okay, so the permitted uses have changed. Okay, as you can see, we still have the original uses, which the payroll costs, as you know, that was salary, that included certain insurances, state taxes, and also for retirement costs. And that had to be at least 60% of the uses. And you then could also have your rent, mortgage interest, if you have business mortgage interest, and certain utility payments. That part really hasn't changed, but the uses got expanded. As you can see, there are 4 new categories. And as I was saying before, because of these new categories, if we can shift some of your previous payroll cost qualification to some of these new categories while still keeping 60%, then you have an opportunity to use some of those payroll costs to get the other credit, which is the Employee Retention Tax Credit, which we'll go into greater detail. So this is a planning opportunity right here. So there are these 4 categories. We're finding that most people are benefiting on this new category stuff relating to the operation expenditures. This really includes just about any software that you use for your business. I mean, if you take a look at all the categories that they use within this, HR and payroll, there's product and service processing, there's billing, inventory. I mean, it's really basically all the software and also cloud computing services that you use. So this is really a big one. Again, this would have to be done during your covered period. You'd have to be paying these expenses during your covered period. And these are for expenses that were in place prior to the start of the period. Then you have other categories. Supplier costs may be a big one for this group. Okay, for supplier of goods, if you've got some goods that are really important to your business, and you are using that, you pay your supplier for those goods, And it seems that those expenses were in place before February 15th of 2020, so that the contract was in place or an order was in place and you're paying for them during the covered period, they qualify. When it comes to perishable goods, for those people who may be selling foods, groceries, supermarkets, etc., those goods actually, you can place orders during the covered period and still count them. Another big one is the worker protection expenditures. We're seeing that a lot as well. Our clients are asking us about this. These are expenses that you had, whether they're capital expenditures or regular expenses that go to protecting your customers and or your employees for sanitation and social distancing issues. So maybe you installed in your workplace plexiglass sneeze guards or some other barriers, or maybe you have gloves for people to put on. Maybe you have sanitizers. It could be that you're using outdoor space, especially if you are a restaurant. We go into Manhattan, there are a lot of restaurants that are using outdoor space, or at least they were until it got really cold in New York. Maybe you have temperature readers. There are things like that. These are all qualified expenses here. And the last category, property damages, we're not hearing too much about that in the New York area, but if you are running a business that was damaged in some way due to vandalism or looting during the disturbances that took place in the summer of 2020 at protesting, those will be covered as well. Next slide, please.
Yeah, and Joe, just to reinforce the point here, like you mentioned, because of the employee retention tax credit eligibility now, whereas in that first round of PPP forgiveness and the first draw, the most advisors and accountants and most businesses just used 100% payroll, right? Because there was really no other factor with payroll. So use all payroll, chances are you get maximum or close to max forgiveness, and there was nothing else to think about. Now with this retroactive change for the retention credit, people should be rethinking that, and these expense categories make kind of give businesses a lot more wiggle room in terms of forgiveness.
Absolutely. Yes. We used to do that for documentation purposes. It was so easy to just do it with payroll.
Yep.
Now that we have an opportunity to shift some of that payroll and get other benefits, as well rely on things that are fairly easy to document. Not as easy as payroll, but fairly easy. And yes, we're going to cover that a little bit later as well. But it can't hurt to reinforce that point. That's for sure.
Of course.
It's a big opportunity for us. All right, so let's go on to some of the other changes that came about with the law. So now the covered period, you got 8 weeks, 24 weeks. Remember, it was originally only 8. They extended it to 24, and only certain people could use 8 weeks. Now everybody can use 8 weeks, 24 weeks, and even in between if you want to. And so they also came out with some new forgiveness applications. So as you know, the process really works that you apply for the money, you use the money properly, and then you have to ask for forgiveness. And we had some people in this polling that were between 0 and 150,000. So we'll start off with that. There's a form 3508S for this. So if you are under 150 or less, you can use 3508S. And if you're actually under 50,000, then you don't even have to deal with whether there's a salary or wage reduction, or whether you have FTE reduction like all the other categories of borrowing would have. And all of this gets done on the 3508S form. It's a very quick form. There's just a couple of places you have to initial off, and you give a little bit of information about the loan. It's really easy on one page. When the loans are between 50 and 150,000, the form is the same, of course, but here you at least have to take into account FTE reduction and salary wage reduction issues. And so you'd be requesting a little bit less money if those apply to reduction for you. The 3508EZ form is for loans that are greater than 150,000. Here you've got to actually make a certification that your FTEs went down, or perhaps you were closed after February 15th due to a COVID restriction, and therefore you couldn't keep the same level of business. That would be another way to qualify. And you would also have to certify that you had no salary and wage reductions from beginning of January to the end of the covered period. The Form 3508, which we sometimes refer to as the long form, has several more pages, has schedules where you have to detail employees, how much you paid them in salary, whether there was a reduction in the rates of pay. The FTEs have to be documented. So this winds up being a significantly larger application form. And if you don't qualify for 3508S or 3508EZ, this is the one you have to use. So it's a little bit more involved. It gets even more involved though when loans are over $2 million. And I noticed that there were some in the polling that were more than $2 million. So here, in addition to this long form, you also have to prepare, and when requested, must submit a loan necessity questionnaire. This loan necessity questionnaire, first of all, I should mention that the loans for $2 million, that includes your affiliates, by the way. So even if one particular business doesn't have more than $2 million, but if combined with affiliates of more than $2 million, this applies to you. So this particular form is a retrospective look. So you may recall that when you applied for the money originally, you had to sort of say, you had to actually certify that you needed the money because there was economic uncertainty. You needed that money in order to make your business run. Well, now, with this new form 3509, it's a retrospective look where the SBA is looking to see whether in fact you needed that money. And I will tell you that there are already lawsuits against the SBA for this, because a lot of people feel that it's very unfair to look back like a Monday morning quarterback and say, well, now you're going to check me to see if that was right. But originally you told me I just had to figure out what it looked like. And there's a lot of merit to that argument against SBAs doing this. But for the time being, this is what we must do. So it's an important step. This is a very important questionnaire. It's got a lot of information that is personal to the business, some of which you might not even feel comfortable disclosing. So look very carefully at this form. So I just want to also point out to you at the back end of the slideshow here, we have an appendix where we're going to have the forms themselves and also a forgiveness flow chart, so to help you figure out which application you need. Next slide, please. Some other changes that were made. Okay, we can go a little bit more quickly here. The EIDL, which I'm sure you know is the Economic Injury Disaster Loan. This has now been cleared, that any advances that you got do not have to be subtracted from the PPP forgiveness, whereas originally it did, which is that's a good thing. So some people got as much as $10,000 as an advance. Now you don't have to do that. Take it off. And the grant is not taxable anymore either. So that's good. This next point, which is the biggest point that we've mentioned before, so we'll save most of this for later. But now the key is that now you can take the employee retention tax credit along with the PPP. Originally, you were prohibited from participating in both programs at the same time. So this is a big one. And again, we're going to talk about this in greater detail later. So the loan calculation itself hasn't changed that much, except that for the 2.5 times the average monthly payroll, now you can use 2020 as a base period, or the 12-month period right up to the loan that you're going to take. Even though it's a first draw, because we're in 2021, the look back can even go to 2020 if that works out better for you. You have a choice. And the $10 million limitation is the same, but if you have affiliates overall, the whole group cannot take more than 20 million. Chris, please, next slide. This is an important point, number 7. You have a deadline here. You must not only apply, but receive the funds by March 31st. So that means that you better make sure you get your paperwork in probably no later than mid-March, because there is time through the bank, through the SBA, and mid-March the latest. And you may try to aim for earlier if you can. Point number 8, there's just it was very unclear in the beginning as to who would qualify because of all the SBA rules that went even beyond the PPP. Housing cooperatives now can qualify, but only 300 employees here, whereas for other businesses, 500 employees qualify for the first draw. 501c6s, which are the business associations, can qualify. And yes, there are a few others that, a little bit more out there. They're not the common ones. Group life and disability insurance premiums are now eligible. This is a brand new thing. So it used to be just health insurance. So now if you pay group life and disability insurance premiums for your employees, which you probably do, they can be taken into account in the payroll costs, which help to build that 60%. So at this point, I would like to turn this over to Barry Sunshine, my partner. Barry's a real tax guru. I'm sure you'll appreciate all he has to say. Barry, take it away.
Thank you, Joe, and good afternoon, everybody. This is my favorite part. For last year, the 2020, just as a backdrop, the IRS came out with interpretations that were very unfavorable to businesses. And what they said was, what the CARES Act specifically said was, any income or any monies that you used appropriately for the PPP income, and that income or that liability is eventually forgiven. That the Congress said that this is non-taxable income. So everybody went under the presumption that this forgiveness income was non-taxable. What the IRS ruled, and it was interesting, and no one was thinking about it, or Congress wasn't thinking about it, was the expenses that the non-taxable income was attributable to and was paying. The question was, the IRS ruled that those expenses would not be deductible, and the effect of which is made the forgiveness income taxable because it would be a wash. So in this new act, they came out with a ruling, and basically, and the law basically is written, and it's basically says, the IRS now agrees that any debt forgiveness attributable to the PPP monies is non-taxable income, and the expenses, to the extent that they were deductible under the old rules, under regular income tax laws, are deductible. They are now deductible. So there's a little vig or a little play that businesses have, because if you had $1 million of PPP money that's forgiven and it was used to pay payroll expenses, you basically have deductible expenses without the related income in there. So there's a little bit of play to businesses on that. What is interesting about it is this: the PPP expenses on for the first draw was used in 2020, and many businesses haven't gotten forgiveness yet in 2020. So the forgiveness is going to occur in 2021. So they may find that they don't have basis to deduct those losses in those expenses in 2020, but in 2021, when the debt forgiveness happens, at that point in time, they'll be able to deduct the expenses. And it was interesting that they said that the forgiveness income does increase an owner's income tax basis. So they specifically covered that in Congress. So that's a very big benefit to businesses that got PPP money, that intends to get forgiveness or will be getting for forgiveness or has gotten forgiveness, because you'll get the expenses deductible, as well as you don't have to pick up the income, and you get an increase in basis. So there's a really good play in there, and it's going to save a lot of small businesses money. Next thing. So, okay, So now for companies that are going through the eligibility for the second draw. So the second draw is you can, if you never got the money, you can go under the first draw, which Joe alluded to. Either way, if you got PPP money in the first draw and you want to now go for a second draw, there are certain requirements and certain eligibility requirements to get this monies. And let's just go over it. The first one is, as Joe alluded to, there was an economic uncertainty that needs to exist at the time of submitting your application. Now, back in March and April of last year, there was a lot more uncertainty in the excuse me, in the economy. Excuse me for a second. In the economy and with businesses, and people didn't know whether they were going to be in business in due course. There's a little bit more certainty, but in order to get the second draw, you need to demonstrate that economic uncertainty and the necessity of funds to support your ongoing operations. So we're always recommending companies to document that either through supporting schedules, budgets, and showing that you really have a need for it. Now, what's really difficult is the SBA really has no rules on this. And they really never really provided any guidance on this as to what is and what isn't. So it's a little bit of a gray area. So a lot of companies are going for the application, applying for it, but again, the safe thing to do for businesses is to document the economic uncertainty and why it's a necessity for you to support your ongoing business. That's one. The second point is at the time of the application, you cannot have any more than 300 employees at the time of the application, and that includes your related parties and affiliated entities. The other criteria that you must have is you must have experienced a decline in your gross receipts of at least 25% or more in any quarter of 2020 compared to 2019, including affiliates. And so there's a threshold that you need to demonstrate now to be eligible for the second draw. The other one is, and this was contentions in the first round, is you still can't be an eligible small business concern. And there's a lot of definitions of it. There's a little bit of vagueness to it, but this ineligible small business concern exists in round one as well as it exists for round two. And basically they said that if you are a political or lobbying activities, and that's more than a certain percentage of your revenue, or you're a dealer or business in operating speculative businesses. And that includes a dealer in stocks, bonds, or even if you're a builder in building homes for spec purposes or for future sales. Those are speculative things. Those are ineligible small business concerns. Again, if you defaulted on a federal loan in the past, you would be an ineligible small business concern. If you are a bank or a financing company or in a lending situation, that too is a small business concern. Another one that we had to wrestle with in our office was if you were a passive business that operated primarily in owning and leasing real estate, under the SBA rules, that would be also an ineligible small business concern. And if you're an ineligible small business concern, you are precluded from getting draw one or draw two, or for that matter, any SBA loans of any sort, not just necessarily the PPP money. So those are some of the criteria. In addition to that, in order to get the second draw, you must have spent, or by the time you fill in the application, you spend all the funds from the first draw before you submit your application. There's a deadline to apply and receive the funds, which is March 31st. So there's a deadline there. Now, I've heard commentary from other folks that indicate that they think that there's going to be sufficient funding by March 31st to fund all of the PPP applications. But again, there is a timing issue because The banks have to process applications for 10 days after they get a completed contract. So you have to submit, if you count back 10 days, and I don't know if it's business days or just calendar days, but count back 10 days to submit the application, work with your bank to find out how it is, but you have to apply and receive your monies by March 31st. And also the second draw loans are capped at $2 million per business and $4 million for all your affiliated businesses and all your affiliated companies.
Hey, Barry?
Yep.
Hey, Barry, I was mentioning before about the Form 3509, where we have businesses that have borrowed more than $2 million and that they have to sort of lay out why the proof that they needed this money retrospectively. I'm just wondering, do you think it's a good idea for even businesses with lower borrowings to take a look at that form and just so that they prepare themselves to make whatever documentation they need for that economic uncertainty?
Well, Joe, that's a great point. And what I've been suggesting and recommending to the clients that I work on with the forgiveness application, I am actually telling them to complete that form for the second draw and put it in the file. You may, if it's under $2 million, you may not need it unless the SBA calls on you. But just to document that, because that gives some clue as to what the SBA is looking for. Okay. Now, I don't, can they look at other factors and other things? Absolutely. But that at the minimum could be a way to document economic uncertainty. Is it conclusive? I don't think so, but it's a good way of supporting that. So that's a great point, Joe. Thank you.
Actually, Joe, I was going to pose the same question. Actually, that's funny. From my perspective, Barry and Joe, on this piece, and we'll get there later, but the SBA does have a period of time, somewhere between 4 and 6 years, to audit any application, right? So while loans under 2 million aren't required to submit that loan necessity questionnaire, right now, as you submit your second draw loan, it's pretty easy for you to remember what's going on in the current times, what customers may have services on pause, what must be closing, or your pipeline is drying up. To document that in some sort of memo and save in your files, just for the fact that if you do get your application pulled and audited 4 years down the road, it's a lot easier to pull out that memo and have a reminder rather than try to think back to today, 4 years from now, and try to remember what exactly you were thinking related to this.
Yeah, and look, what we're talking about is this certifying your economic uncertainty. There's no black and white. It's all gray area. And one of the things that the application or that 3509 form doesn't talk about is not how well you're doing, how well your customers are doing. Because, and if you're close with your customers, you may find that your customers aren't doing well. And if they're having economic uncertainty, that means you may experience in the future some economic uncertainty. So these are the factors that need to be baked into your support to document that there's some economic uncertainty. So these are really great points. You can't play, you got to play it by the ear and be very, very cautious in this, because again, you don't know, you're documenting at the time of the application, as opposed to 2-3 years later, when if you're in business and doing really well, it's harder to demonstrate the state of mind when you put the application in. So that's all a good point. Now, besides the ineligible small business concerns, there are the new laws definitely came out with some specific ineligible companies, and some ineligible companies are publicly traded companies. If your company was not in business on February 15, 2020, you cannot go for round 2. If you are the recipient of a shuttered venue operator grant, you are not eligible to get the PPP money. And it may be better off getting the shuttered venue operator monies as opposed to the PPP money. We'll go over that a little bit later on, but you can't get both. If you actually received a second draw already, you can't get another draw. You can't get like a third draw, or you can't get a second one. And then there's other ones dealing with, publicly traded companies and other ineligible businesses. Probably in the minority, but so there you go. So that's that. Next slide. The next one is when we talked about a decline in gross receipts. To accountants, gross receipts means there's a cash basis, accrual basis. I think the SBA definitely came out with rules saying it's the gross receipts that your company normally uses for income tax purposes and how you maintain your books. So what you have to do is you have to look at your gross receipts in each of the quarters, quarter 1, 2, 3, and 4, and compare it to your gross receipts using the same method of accounting that you used, and compare it to the similar quarters in Q1, 2, 3, and 4 of 2019. If your gross receipts are 25% decline, 75% of that number or less, then you would be eligible for it. Now, you have to include gross receipts for all your affiliated companies. You just can't selectively pick. If you own 5 companies, 100%, you just can't do that calculation for 2 companies. You have to do it for all 5 companies in aggregate. Okay, and if you meet it on an aggregate basis, then all 5 companies are eligible. So that's the rules. There's special rules for entities not in existence in 2009, but let's not go into that. So when they talk about the definition of what gross receipts includes, and again, it's the accounting methods as reported for income tax purposes as reported to the IRS. It's basically revenue from the sale or sales from the sales of product or services, any interest and dividend income and rental income and royalties and fees and commissions. And if you have sales, you can reduce it by your cost of goods, sales returns and allowances and so forth. So those are the things that are included in there. Sometimes your gross sales include sales tax collected. That you can back out because that's just a pass-through activity. And because you have to do it because you have to do the calculation on an affiliated group, there may be transactions between revenue being recorded from one company and an expense report in the other. So to the extent that there's intercompany transactions or intercompany sales or fees or something like that, that can be backed out. And it also doesn't include the gross selling price on capital gains and or losses on it. So those are some of the high-level things on gross receipts. It's very important to do. It's very important to document it correctly. And I can't emphasize it anymore, but it's very critical. And just you want to qualify for it and sharpen your pencil, make sure it's right. And with that, I'm going to turn over what documentation is needed to Chris Zengali. Take it away, Chris.
Thanks, Barry. So the documentation piece is a really interesting part of this whole process. The SBA has their set of guidelines as to what's required in terms of documentation. So in terms of documenting your gross revenue reduction, they request a tax return if available, otherwise financial statements and or bank statements showing your reduction in gross receipts from one quarter to the other between 19 and 20. For loans under 150,000, this support is not required to be submitted with the application. However, you will be expected to provide support on or when you request forgiveness. So when you submit your forgiveness application. For loans over 150,000, those businesses are required to submit this documentation at the time they apply for the loan. This third bullet here, which is a very key piece, which went unnoticed, and I personally have heard of at least 2 applications that have got sent back to the company for this. The financial statements, if they're not audited, which I'm assuming they're not, because I can't imagine there are many businesses that have completed their 2020 audit yet. But if they're internal financials, so it's something generated out of QuickBooks or out of whatever accounting software, the financial statements must be signed by the business owner. This is a piece that I know Chase Bank didn't have this requirement originally. I believe it was an IFR or something came out subsequently, and Chase ended up updating their requirements for this. But this is something that's really important. If you haven't submitted yet, make sure when you submit those financial statements, that it is every page, I believe, has to be signed. Other items to note, we have seen some instances where the business is required to submit their 19 or their 20 tax return, depending on what period of payroll you're using. Now, this slide was a lot more meaningful when SBA was releasing guidance, but as we've started working with a lot of these lenders and we're seeing what lenders are requiring, the lender is requesting whatever information they want to request. So there really isn't a standard set of documents that every lender is requesting. So if you haven't submitted already, we recommend just reach out to your lender and find out what exactly they're expecting from you, because it does vary pretty widely. How is the loan calculated? We could get through this pretty quick, because I know we are coming up short on time, and we want to make sure we spend a decent amount of time on the employee retention credit. We went over, loans are capped at $2 million. They're calculated by 2.5 times the average monthly payroll for either calendar year 19-20 or the trailing 12-month period prior to the loan disbursement date. For seasonal businesses, you can use an average payroll for any 12-week period between February of 19 and February of 20. And the most important piece of this whole thing is for businesses with the NAICS code of 72. So it starts with the 72, that's the accommodations and food services industry. This is your restaurants, hotels, quick food service, stuff like that. Those businesses are eligible for 3.5 times their average monthly payroll. Because this industry was probably the most negatively affected industry throughout the pandemic, this was something that's built into this second draw, which does try to help these businesses a little more than, it gives them a little more support than other businesses has gotten. And on the note on this one, especially for restaurant chains, the 300 employee limit is based on physical location. So if you have 10 restaurants, you're allowed 300 employees at each location. It's not just 300 total across all 10 restaurants. Financial statement reporting. We're going to cover this really high level just because it's at the bottom of the page here, but how you report for PPP is really based on management. It requires a considerable amount of management's judgment. There's no one size fits all answer. And really, we do recommend that in how you show PPP on your financials for a year-end 2020 financial statement. Consider the effects of your lenders. Granted, yes, all lenders and most financial institutions understand the PPP and what's been going on, but you have to look at your business and see what makes most sense for you. There are 3 key scenarios. The first is you treat the PPP as debt. You keep the liability on your balance sheet for year end, and you don't recognize the income until you get word of forgiveness from the SBA. That's probably the least risk there. You keep it on the balance sheet, and there's not really much judgment to happen there. The second piece is you recognize the deferred income upon receiving the loan. So if you believe with reasonable assurance, now that reasonable assurance is one of those weird, what percentage, and I know GAAP has different percentages of over 70% is this and 50% is that. But if you believe with reasonable assurance that the loan will be forgiven, you can recognize the income over the period that the expenses are incurred. So that would mean that you would take the forgiveness as income during 2020. So option 1, you keep the loan on the balance sheet. Option 2, you recognize the income. And option 3 is treating it as a gain contingency. Really, you're just disclosing it in the notes to the financial statements, and you're not recognizing income until the gain is realized or realizable. Pretty much the same thing as number 1. You don't recognize the gain until it's legally released by the SBA. Again, talk to your accountant, talk to your advisor, see what makes the most sense for your business here. There is no one size fits all. Let's hand it over to Barry. He's going to cover the loan forgiveness timeline at a high level.
Actually, Chris, this is something I'll be doing.
Oh, sorry, Joe. Yeah, sorry about that.
That's all right. But thank you, Chris. That was very good. Okay, so this is actually the last slide on the PPP. And so then we'll get into other areas. But just to give people a bit of a timeline. So, the initial process obviously is to get the money, and now it's time to get the forgiveness. So with the forgiveness, the thing is you must submit your forgiveness application within 10 months after the end of the covered period. because if you don't, you'll have to start making repayments, and that would include interest. So that's something you want to make sure you know where the end of your covered period is, whether it's 8 weeks or 24 or some other covered period. You want to make sure you're on top of that. Then the lender has 60 days to review, make sure everything is properly documented, make sure that that they look it over and see that your calculations are pretty accurate, and then they turn it over to the SBA, and they're looking for payment from the SBA. And the SBA has another 90 days to review the application. They review all of the documents, all the backup. They're looking to see if people submit the loan necessity questionnaire for the people who are over $2 million. I mean, this is where the process really gets heavy. So think of the review process as 150 days. The 60 days that the bank has, 90 days the SBA has. Obviously, it could be shorter if they don't use all the time, but you got to kind of think about that before you can let your breath out. So the lender then notifies the borrower, I should say, of the forgiveness amount, and that's kind of when you can start to say, okay, well, I think we got past this. But even then, you have to understand that the SBA has up to 6 years to review. They call it review, we call it audit, same idea. They can go back and say, you know what, you need to explain this or explain that. But they did say in this last round of legislation that you need to keep records for 4 years for employment records and 3 years for other. So even though they have the right to review for 6 years, they're saying that you don't necessarily have to retain your records all that long. Not sure exactly how that works, but anyhow, that's the rule.
Chances are you have payroll records for longer periods of times anyway.
Well, we always advise people to keep payroll records for 7 years anyway. So that's, yeah, you're right. All right. I'd like to take the next slide and get into what I consider to be a very exciting area here. It's exciting because it's reworked. It's a lot of money potentially. This is an area that a lot of people don't even realize because so many people have been focused on the PPP. Well, now, and also when this first came out, you couldn't even use it if you were in the PPP. So now you can. The idea is that you can use payroll costs for the employee retention credit, and you can use payroll costs for the PPP, but you cannot use the same payroll costs for both programs. And so if you remember earlier on in this program, we mentioned that the new categories that you have, those 4 new categories, allow you to do a little shifting. So if you can qualify with 60% of the payroll costs for the PPP and then start using the other categories, you probably have more payroll costs during that covered period that you can now use for the employee retention credit. So it's really an opportunity for you. So there are 2 parts to this credit, really. We look at it as a 2020 credit, which is the original program, but now with the allowability of using it while you're with PPP. And then there's a new program for 2021, which at this point is only for 2 quarters, the first 2 quarters of 2021. So I'd like to start off with the 2020 credit. Let's talk about what really has to happen here to get this credit and what it means. So you've already filed some 941s for 2020. You should have filed all 4 quarters. If you are now entitled to a credit for 2020 for this employee retention credit, but did not take it because you didn't think you were qualified or you weren't qualified prior to this new law, you now have an opportunity to get a refund. And so the way the law was written, that you could either amend the return for that's the 941 returns, that's the FICA and federal withholding tax returns. You can amend it for the periods that apply. Or if you didn't have an opportunity to do that and you wanted to roll it into the 4th quarter, you could do that. But now we're already in February, that 4th quarter return should have been filed already. So at this point, we're talking only about amending the returns for 941. This is your opportunity. Okay, so first of all, who qualifies? Okay, so this is also a gross receipts test. For the 2020 credit, you had to have experienced a reduction in your gross revenue of 50% or greater in a calendar quarter. And then what you would do from that point forward is watch the following quarters, which we're going to get to in it as well. But also, even if you didn't experience a 50% or greater reduction, you could qualify if your business was partially or totally suspended by a COVID restriction. So this is often overlooked. If that were the case, even without a 50% or greater reduction, you could use this credit. So what do you use this credit for? Okay, you use it for wages and health insurance paid for your employees. Okay, and it starts on March 12th and goes to December 31st of 2020. So what you do is you look back and see whether what you're paying for health insurance and for the wages for those people during that period, bearing in mind that you cannot use the same payroll costs for that you use for the PPP, and you work from there. But again, you're only going to be doing it for periods where you experience this reduction and then another one. And how does that apply? The next box says what to do here. First, look for a 50% plus reduction. So for example, let's say you had a reduction of more than 50% in your second quarter of 2020 as compared to second quarter of 2019. That's where it starts. Then the next quarter, you take a look and see whether you have gotten to get back to 80% or more of your next quarter. In this example, it would be the third quarter. So if you went to the third quarter and look to see whether or not you've gotten back to gross revenue being at least 80% of the third quarter of 19. If you have gotten back, you're still allowed to take it for that quarter. If you have not, then you get to continue to another quarter. Then you go to the fourth quarter and see if you've gotten to the 80% reduction, 80% of the fourth quarters of 2019's revenue. And then in that case, you would be able to have it for possibly 3 quarters. And that extends beyond the PPP. And therefore, you would probably be able to use payroll without any problem. But even those that are just using 1 quarter plus 1 extra, we're finding that many people are getting the use of payroll that they're taking from the PPP. When you do this test, by the way, you need to look at affiliated companies. So if you are an affiliated group, again, you're this common ownership, that's what we're talking about. You need to count the reduction of revenue for all of that affiliated group. It's not just a single company. You need to look at it on an overall aggregate basis. So how much is the credit? Well, the credit for the 2020 year is 50% of $10,000 of the first $10,000 of wages. It doesn't have to be the first, of any $10,000 of wages, plus the health insurance per employee. So potentially it's $5,000 per employee for 2020. Now, it's important to understand that that certain people, certain companies cannot use this. If you had an average of under 100 employees if you had an average of under 100 employees during 2019, you can use this for all your employees. But if your average employees were over 100 in 2019, then you can only use it for the employees that were not working, that you were paying or covering health insurance for during that period. Another thing that to keep in mind is that this is a credit that actually reduces your payroll deduction for tax purposes. So this is not a grant, this is a credit, but you do have to pay tax on this as it becomes taxable when you have to reduce your payroll deduction. So just keep that in mind. There's a way to get some credit back through the Form 7200, which is an advance credit. And if you don't do that, you just get a reconciliation on 941 and you can just get your refunds back there. So there are different ways to get this money. And as mentioned before, there's actually a way to even suspend some of the payment on your payroll tax deposits moving forward to 2021. I'm not really recommending this, only because you'd have to be really careful. Just if you want to look at this with your accountant, you should do that. Probably because there's a potential for penalties if you don't pay in enough of your taxes. So it's not necessarily the best strategy to get the money, but it is definitely out there. Let me talk a little bit more about the 2021 credit, because this is quite different. So instead of a 50% reduction, here you only need to get a 20% reduction. And now we're talking about looking at the first quarter of 2021 versus the first quarter of 19. Or if you want, you could actually go take a look at the fourth quarter of 2020, which the statistics are already there, versus the fourth quarter of 19. So when you're looking at your gross receipts, you have this option for the first quarter. And then you have, for the second quarter, you'll have a similar calculation where you can go take a look at the second quarter of 2021 versus the second quarter of 19. And this is another opportunity here. But there's some other differences here. One of the things is that you can do this only for 2 quarters, right? But the credit is 70% instead of 50%. So now instead of being $5,000 cap, it's $7,000 cap, but it's per quarter. So since you can do it for 2 quarters, you can possibly get $14,000 per employee. So overall, on any particular employee, using the 2 years worth of credits, you could possibly get back $19,000 for that one employee. And obviously, if you have many employees that qualify, this can turn into hundreds of thousands of dollars. We've even seen some over $1 million. So this is big bucks. This is why I'm so excited about all this. And what makes this 2021 credit even sweeter, if you will, is that now, remember that rule I mentioned before about having an average of 100 employees or more in 2019? Well, now it's over 500 employees. So if your average employees were under 500 in 2019, then you can count all your employees. And if there was over 500 employees in 2019, then you can only use it for the non-working ones. But it's exciting. This is big money out there. There's a possibility for lots of businesses to get back money and get it back through a refund. So it's really, really good. Just one more point I want to make, and that is that Janover, what we're doing with our clients is we're asking our accountants to, when they're working on the year-end accounting and the year-end tax returns, to take a look and see what these quarterly reductions are, so that we can find the opportunities for our clients. I'd like to turn this over to Barry. Barry, please finish us off. Thank you.
Yeah, thank you, Joe. And we don't want to minimize this employee retention tax credit, because just to bring it home, if you have a company that has a business that has 50 employees, and if they qualify for it just in 2021 at $14,000 for Q1 and Q2, that's $700,000. That's a lot of money to be putting into businesses' pockets. So not to be taken lightly, and looking at that very seriously. The other piece is that if you don't call, if you operate a shuttered venue, a live venue operator, promoter, theatrical producer, live performing arts, motion picture theater, they're suffering a lot with their business. So if you go for the PPP, you're not eligible for the shuttered venue operators grant. But so you may want to look at this, because this number isn't based on 2.5 times your average monthly payroll. This is actually based on a percentage of your 2019 revenue. So if you operated one of these entities and you were if you were in business on February 29th of 2020 and you didn't receive PPP money subsequent to December 27, 2020, you did suffer a 25% reduction in any quarter in 20 versus 2019. And I have a lot of clients that are real estate operators that have tenants that were closed and didn't pay the rent because they weren't getting any revenue, so they would qualify. And they intend to open, and they're going to reopen, and they're certified the economic uncertainty because they don't know if the theater is going to be in existence. Basically, the grant is based on 45% of your gross revenue, of the operation's gross revenue, and it's capped at $10 million and $60 million for an affiliate. So if you do operate these type of venues, or you're a real estate operator and you have tenants in this, one of the eligible costs is rent. So this is how some of our real estate clients are getting back up on their collecting back rent, as well as anybody who's operating in this space is able to get this money. So the next one is a polling question that we have. And the question is, would you like someone from our team to contact you to assist you with the PPP or the employee retention tax credit? Here's your choices. We'll give you a couple seconds to complete it.
You want to just bring it home, Barry?
Yeah, and the next step, one of the next steps, I always leave this webinar, the webinars, with what the business owner should take away from this. The first thing they should be doing is looking at their quarterly gross receipts to determine and look at your eligibility for whether you're eligible for the PPP second draw, and also the employee retention tax credit. Sharpen the pencils, do the calculations. If you need assistance, we're here to help you. Look at the covered period, because remember, the covered period starts when you get the money deposited into your account, and you can pick and choose up from 8 weeks to 24 weeks, your choice, as Joe had talked about. And you got to make sure that you're going to qualify and determine, and you have eligible salaries for both, because you want to maximize the credit / PPP and your forgiveness. We are always suggesting to work with your advisor to maximize your loan forgiveness with the application, and also work with your advisor in the employee retention tax credits, because this is a specialty. It's very complicated, and Joe and I was talking about it this morning, but we've been living with this for almost a year right now. So thank you very much for your time. This is our contact information on behalf of the partners and professionals at Janover. We want to thank you for attending our webinar. Appreciate it, and have a wonderful day.
Thank you very much.
Thanks, everybody.